Good morning, everybody.
Sorry.
We can get a little bit of an early start to say some thank yous.
Okay.
Great crowd today, great day, beautiful day out. Hopefully everybody enjoys what they take in the information today. Take home what you have, maybe sit outside, read some more about it, Google all about the big beautiful bill, and if you got nothing else to do today. But again, thank you for all coming out on a Wednesday morning, taking time out of your day for this. It is, at least to us, it's very important. I know it's very important for all of you guys as being clients or referral sources. So we do thank you for that, and thank you for the relationships that we do have amongst us. We do have, do want to at least mention, I am Scott Weber, one of the principals in the Edmondsville office. We do have a couple different offices. We've got staff from the Highland office and the Edmondsville office. They're going to be kind of mixed around a little bit. To maybe introduce some of the individuals. Dennis Urick, principal in our Edmondsville office. We got David in the back, who's our IT, doing the live stream, so we thank you for that. Mike Fitzgerald and Corey from Alton will be your presenters today, so we thank them for putting all the time and effort in for this. Some of the Michael Urick from our Highland office, the principal. Chad Burns from our Shuffle Financial Services, thank you for the support. Mark Cordy is around here somewhere, so thank you. Did I miss anybody? Michael Brokering, sorry here. The shiny thing didn't hit me right off the bat there, sorry. And also, just real quick, we do have, and we appreciate their support as well, some retired principals that have come back and wanted to learn some more. Maybe they're coming back, I don't know. So, Russ Gregson from our Belleville office, so thank you for coming. Steve Langendorf was principal in our Edmondsville office, and I think Ron Schneider from our Highland office, so thank you again for coming. Again, thanks for everybody coming today. Hopefully, wait for questions at the end. We got enough staff here, even at the end, if you wanted to mingle afterwards and ask some questions. So again, thank you very much, and enjoy the presentation.
Yeah, I think we'll go ahead and hold the questions until the very end because we've got the live stream going, so some of those people are in an hour constraint, so we'll do that at the very end. And like Scott said, everybody that walks around with a tag like this is Shuffle Boyle. Today's your day for free information. They can't charge you, right? But remember, you get what you pay for, so don't think they're going to give you a whole bunch of free stuff. I'm going to have to do a bunch of these things today. Yesterday I had somebody flipping the slides, and I can't even see the slides. Okay. So this is the one big, beautiful bill. If you don't know the name of this bill, you guys have been under a rock for the last 6 months, because how many times do you think Trump said one big, beautiful bill? So that's what we're going to talk about today. A lot of what we're going to discuss is really carrying over the tax information that was passed back in 2017. That was the Jobs Act and Tax Cut bill. And it did a lot of the lower brackets, and a lot of this information we're going to talk about happened back in 17, but remember, it sunsetted. So we had this estate exemption sunset. The brackets were sunsetting. All these things were sunsetting. And so what this is a lot of is just a continuation of what we had before. So I'm going to cover individuals. That's going to be the vast majority of mine. I will talk about estates on a couple of slides, and then Corey will take care of handling the information on corporations. So to start off with, you can't really talk about the one big beautiful bill without talking about the rate reductions as well as the bracket adjustments. And I'll explain the bracket adjustments here in a minute. The bracket adjustments have been permanently set up to increase with inflation, and these rates are permanent. They are not, so unless you get a Democratic president, Senate, and House, these rules, for the most part, are going to be permanent. So we don't have to worry about things changing. Although change always happens, and I'm old enough, I remember when Ronald Reagan started making all these changes and everything was permanent, but if one thing does change, it's income tax law, so don't think that it won't change. So the first slide we'll really talk about is going to be the rates. And just so you have an idea maybe of where you fall into, you can look on that screen. But we've got the 10, the 12, 22, 24, 32, 35, and the top bracket is the 37. Just for comparison purposes, under the old law, those rates were 10, 15, 25, 28, 33, 35, and 39.6. So the rates are down, but the most important thing are these brackets. So you can see we've got the brackets for single, married, filing joint, and head of household. And just to give you an idea, under that old law that was supposed to kick into effect, currently the 37% bracket for a single person doesn't kick in until $626,000 of taxable income. Under the old rule, that kicked in at $418,000. So you can see that those brackets have expanded, they've gotten much larger, and so you stay in those lower brackets for a longer period of time. So the rates are great, but the bracket expansion has even been better. And just for comparison purposes, married filing jointly, back under the old law, the top bracket of 39.6 kicked in at $470,000 of taxable income. You can see now the 37, the top bracket, doesn't kick in until $751,000 of taxable income. Also, more good news, the capital gains rates, those have been retained. So the capital gains rates are 0, 15%, and 20%. So technically, you can't pay any more than 20% on a long-term capital gain. Short-term gains are ordinary income, but long-term capital gains, 20%. Now you have the Obamacare tax, which is at 3.8% Medicare, and there's some other ones that might clip you as well. But for the most part, just for income tax, it's a 20% top bracket. Also, I want to bring to your attention, and as we go through this, you're going to hear about standard deductions and all those things getting higher. Take a look at this married filing jointly. So those of you who are married filing joint, you're in the 0% capital gain bracket all the way up to taxable income of almost $97,000. So if you've just retired and you haven't started your Social Security yet, or you haven't started your pension or whatever it is, and you've got some lower income, what we're hopefully going to talk about to raise a few ideas in your minds today is maybe being able to pull some money out of an IRA, maybe doing a Roth conversion, maybe selling some capital gains stock that you've had for a while that maybe is built up pretty nicely, and you're like, well, this might be the top of the market, maybe I'd like to sell some. You can maybe sell some of these things and maybe pay 0 capital gains tax for federal purposes. Now remember, Illinois, you got to pay the 4.95. So you do have to pay Illinois those capital gains, but maybe not have to pay any capital gains on long-term gains if you're in the lower bracket. Again, that's why we're doing these here in November. You still got 2 months of time between now and the end of the year to maybe talk to your accountant and then go ahead and start doing some of these types of things. Standard deduction. Back in 2017, when this bill passed, they basically doubled the single and married filing joint exemption, or standard deduction amounts. And again, this law just continued with those. So you can see, for single people, the standard deduction for 2025 is $15,750. For married, it's $31,500. And they already have amount for 2026 at $16,100 and $32,200. Over 65, you still get the extra deduction. If you're single, you get $2,000. If you're married filing joint, you get $1,600 for each person who's over 65. And the same if you are technically blind, and that's legally blind. You don't have to be blind, you just have to be legally blind, and you can take that extra deduction. Under the law, we do have a new deduction, and again, for everybody in here who's 65 or older, there's a lot of gray here. I've got mine too. So this might be applicable to a number of people. There's an extra deduction. This is only for the years 2025 through 2028. And you get an extra $6,000 standard deduction if you're 65 or older for a single person. And if you're married filing joint and they're both 65 or older, You get a 6 for each, so that's an additional $12,000 deduction. It does phase out for people with higher income, and so I've done the calculation for you. You can see that if you have a MAGI, which is modified adjusted gross income, for a single person at 75, the 6,000 starts to phase out, and by the time you hit 175,000 of AGI, it's phased out completely. And for marrieds, it starts at 150, and again, phases out completely by the time you hit 250,000 of AGI. So just as an example, if we have an older couple, they're both over 65, and one of them is blind, and they have limited income, what's their standard deduction? So again, married filing joint for 25 is $31,500. We have one blind person, so they get an extra $1,600. They're both over 65, so they each get the additional $6,000 deduction. And then because they're over 65, they still get the old extra deduction of $1,600 each for a total of $32,000. So you can see that this couple will get a standard deduction of $48,300. So that's what I'm talking about. You get gross income, and then you come down to your standard deduction, and then that brings you down to taxable income. So you can see with this $48,300 deduction, there may be some room to do some planning if you're in some of those lower brackets. Child tax credit, those of you who still have children, this is a continuation of the old rule, but the old law, each child with 17 years of age or younger, you got a $2,000 credit. The new law just expanded that a little bit. It took it from a $2,000 credit to a $2,200 credit. The other nice thing about this is that $1,700 of that $2,200 is refundable. Now, what do we mean by refundable? Refundable means that if you get those higher standard deductions and maybe you've wiped out your income and you don't have any tax, you can still get $1,700 back from the government as a refund for each child that you have who's 17 or younger. Again, it phases out as income goes up. Single, it starts phasing out at $200, it's gone by $244. For married, it starts phasing out at $400, and it's gone by $444. State and local income tax. This got a lot of discussion during the summer when they were trying to get this bill passed. We refer to this as SALT. So it's state and local income taxes. And what we're talking about is if you itemize your deductions. In the past, you used to be able to write off all of your real estate taxes, all your state income taxes. If you didn't take the income taxes, you could take sales tax. There were all kinds of provisions you used to be able to write all that off. In 2017, that was reduced. The most that you could write off for all of those combined taxes was only $10,000. Under this law, they just expanded that up to $40,000. Now, the $40,000 is going to be indexed, and it only goes up by 1% per year, and you can see from the slide what that goes up to. But then in 2030, this is going to revert back to a maximum of only a $10,000 deduction for an itemized deduction. So we talk about the SALT limits of $40,000. For those of you who make more income, the $40,000 starts declining. So for AGI, over $500,000, and this is for single or married filing jointly, it's the same limitation. So once you hit $500,000, that $40,000 deduction starts phasing out. And so by the time you hit $600,000 of AGI, you're down to the $10,000. So your question might be, well, if I make $1 million and I do that calculation, I'm going to be negative. Do I have to subtract from my itemized? And the answer is no. You don't go lower than the $10,000. So no matter what your income is, you'll always get at least the $10,000. Okay, and then under the old law, prior to 17, there was something called the PEASE, P-E-A-S-E limitation for those who had higher income. To the extent that income exceeded certain thresholds, you lost 2% of your itemized deductions. This law has permanently thrown out that PEASE limitation, and there's no such thing as a PEASE limitation anymore. However, they came up with a new limitation. It's not called the PEASE limitation, but there's a new limitation. So the Act now reduces itemized deductions by 2/37 of the lesser of, 1, the amount of the itemized deductions, or 2, the taxable income that exceeds the 37% bracket amount. How's that? Okay. So I don't know what the heck it is. Hit the off button. So that's a lot of gibberish, but let's just go through a quick example and you'll find out it's not such a big deal. So I have a single taxpayer with AGI of $680,000 and they have itemized deductions of $50,000. So the first limit is I lose 2/37 of my itemized deductions. So 2/37 of the $50,000 is I could lose up to $2,703 of deductions. But then I run through the second phase of the limitation, and the income was $680, my itemized deductions were $50, so my taxable income is $630,000. That 37% bracket doesn't kick in until $626,350, so I only exceed that limit by $3,650, and 2/37 of that is $197. So you would lose $197. So what they're basically trying to do is limit the amount of benefit that you receive from itemized deductions to the 35% bracket. And that's why you're losing 2/37, is because you're losing the 2 percentage points between the 35 and the 37% brackets, and that's what they're making you lose. So that's what that is. Again, no matter what you do, under this limitation, if you've got tremendous amounts of income, you can't go lower than the standard deduction. So you'll always get at least the standard deduction. Also, years and years ago, we used to have something called alternative minimum tax, and it used to hit a lot of people. Since 2017, it really hasn't hit anybody because they expanded the thresholds and the exemption amounts. And so all I'm telling you is if you have not been hit with AMT since 2017, you won't be hit with it anymore because they've gone ahead and continued the expansion of those brackets. Those were set to expire at the end of 25, and they are not expiring, they have been extended. Personal exemptions, we used to get a deduction for yourself and your spouse, and if you had children, you could take deductions for all those. Those were personal exemptions. We haven't had anything remotely deductible for a personal exemption since 2017, and under this law, they have thrown that definition even out of the code. So there's no such thing as a personal exemption anymore. Interest expense, this is new. Interest expense on a new car. So only for the years 2025 through 2028, individuals can deduct up to $10,000 of car loan interest per year. It starts phasing out at $100,000 for single people, and it's gone completely at $150,000, and it phases out for married filing joint. It starts at $200,000 and it's gone by $250,000. So what are the requirements for that? The car had to be purchased and the debt had to have been incurred after 12/31/24, so 1/1/25. It must be for a new car, and it has to be for personal use. The car can be either a car, minivan, SUV, pickup, motorcycle. It just has to be less than 14,000 pounds gross vehicle weight. So that's going to take pretty much everything into account. And one of the other requirements is final assembly had to be made in the U.S. So parts can come from Japan, they can come from Mexico, they can come from Canada, but basically final assembly has to be in. You think, well, how are they going to know that? The answer is you have to put the VIN of that new vehicle on your tax return, and the IRS can tell from that where that car was assembled. Next one, enhanced child care, dependent care. This is really daycare, is what we're talking about. The expenses have remained the same. It's always been $3,000 of expenses for daycare for one child, and for 2 or more children, that limit is caps out at $6,000. What's changed here is the percentage rate of the credit. So it used to start off at 35% and go down to 20. It now starts at 50%. And then you can see from the tables, it phases from 50 down to 35. Then you stay in a 35% bracket for a period of time. And if you exceed that income limit, then it starts phasing from 35% down to 20. And by the time you end up with AGI of $105,000 for a single, it's just a flat 20% credit, and for married filing joint, that limit is $210,000. Qualified resident interest expense. Again, years and years ago, we used to be able to deduct interest expense on up to $1 million of home equity or home indebtedness, mortgage indebtedness. That got reduced down to $750, and under this law, it continues at a limitation of $750. Usually not a problem in this area. I've got kids that live down in Destin, Florida, and I've got another one that lives in Raleigh, North Carolina, and everything down there is more than $1 million. But around here, I think most people don't have a problem with starting off with mortgage interest debt of $750,000 or less. Itemized deductions, we used to be able to deduct these. These were things like your tax preparation fee, your union dues, your license, if you're like a nurse or whatever, your nursing license. All of those used to get bogged down into miscellaneous itemized deductions. We haven't had those since 2017, and this law permanently disallows any miscellaneous itemized deduction. For those of you who might be teachers, we've had a $300 above the line deduction the last number of years. The law increased it to $600 if both parents are teachers. So you get a $600 above the line deduction. And then starting in 2026, for all teachers between kindergarten through grade 12, the teachers, counselors, coaches, principals, all those people associated with the school, they can deduct as an itemized deduction unlimited amounts that they spend on their classroom or coaching, mileage, all those kinds of expenses will get thrown into that. So you still get the $300 and $600 above the line, and then you can take any other expenses that you have as an itemized deduction if you can get over those standard deduction amounts. Trump accounts. This has got a lot of coverage, so we'll spend a little bit of time on this one. Just so you understand, a Trump account is a tax-deferred investment for children. You can receive contributions from parents, from grandparents, from relatives. Employers can also donate up to $2,500 into a Trump account, but they cannot discriminate. So if you think, well, my grandkids, I own a business, I'm going to put $2,500 into a Trump account for each one of my grandkids. Not only are you going to do it for your grandkids, you're going to do it for all your employees' grandkids and their kids as well. So you can't discriminate. If you do it for one, you got to do it for everybody. But just so you understand, employers can put it in. The child has to be a U.S. citizen, has to have a social security number, and has to be 17 years of age or younger. Contributions are limited to $5,000 per year per child, and you cannot take a distribution. That child cannot take a distribution until at least the age of 18. It is just not allowed. So if you've got 529 plans, I know Chad talks about 529 plans a lot. You know, that money can come out of a 529 to pay for grade school, or for high school, or for uniforms, or for a computer. Under this Trump provision, you can't pull anything out until that child's at least the age of 18. And if they start pulling out at 18, and they pull it out before 59 and a half, then there's a 10% penalty on whatever it is that they pull out of that Trump account. And continuing more with Trump accounts, also, children born in the years 2025 through 2028 who are U.S. citizens and who have social security numbers will receive a $1,000 deposit from the federal government. Now they talk about being born in 25, but they've already said none of these Trump deposits are going to happen until at least 2026. So some people have said, well, maybe they'll let you do it on your income tax return, give you a $1,000 credit, so you get $1,000 extra money back that you can put in the account. I don't know if that's going to happen, because what you're supposed to do is you're supposed to go to a bank or some financial institution and set these accounts up, and the government somehow is supposed to put that $1,000 into your account. Good luck with that one. Okay, changes to charitable donations. Under the Act, there's a new above-the-line deduction for people who do not itemize. So remember, those standard deductions are so big that a lot of people don't get any benefit from their charitable donations. This is an above-the-line deduction. So even if you don't itemize, you take the standard. If you're single, you can take up to $1,000 above-the-line deduction. And married, filing jointly, you can take up to a $2,000 deduction. So only for non-itemizers. This isn't like the teachers where you can take it above the line and below. If you're an itemizer, you can't take anything above the line. It all has to be an itemized. But if you don't itemize, you get to take these. This starts after 2025, so it starts in 26. It also excludes donations to donor-advised funds, private foundations, or non-cash. So if you come in and you say, hey, I gave $1,000 worth of used clothes to Goodwill, that's not going to qualify. It's got to be check or cash or whatever to that charity. Also, under the old rule, we could only deduct charitable donations to the extent that up to 50% of AGI. That got changed to 60% a few years ago. This law has permanently established that 60% ceiling. So going forward, the maximum amount that you can give away to a charity in any year is up to 60% of AGI. If you gave more than that, it carries forward into future years. There is, however, a new floor limit. And this act provides that for a 0.5% of your AGI floor of the taxpayer's contribution base. So what's that mean? So here's an example. If you have AGI of $300,000, 0.5% of that is $1,500. So what they're telling you is, if you gave $10,000 to charity that year, you're going to lose the first $1,500. This starts in 2026, so 25 maybe seems like it's the last year. So if you go bunch donations or whatever into years, 25 may be a little better a year. Also, it's not new under the law, but I just wanted to bring it to everybody's attention, and everybody hopefully should know this. For those of you who are 70 and a half or older, you should seriously be thinking about making your charitable donations from your IRA. So you call up your IRA trustee and say, hey, I want so much money to go to my church or go to Salvation Army or whoever it might be. And they will write that check directly to the charity. What that does is it counts towards your RMD. Okay, so your required minimum distribution counts toward that. But what happens is it goes straight to the charity, and so you get to subtract that up above, so it reduces AGI. So anybody who's trying to keep their Medicare premiums lower, or maybe looking at medical deductions and limitations with AGI, it affects the AGI. So try to do your charitable donations, if you're 70 and a half or older, through your IRA or RMD. Now, people get confused because they've now extended the age before you have to start taking money from your IRA. So that's now age 73. But what I'm telling you is that this special qualified charitable donation can start when you're 70 and a half. So even though you haven't had to start your RMDs, this will allow you to still do that qualified charitable donation. Moving expenses. These were thrown out a number of years ago. The law just permanently throws them out as a deduction unless you were in the military and you were moving for military purposes. Then we got overtime pay. This was one of Trump's big things that he talked about. There's no income tax on some overtime pay. So beginning in 25 and retroactive back, even though this bill passed on July 4th, they made it retroactive back to January 1st for this overtime deduction. The law now allows workers below certain income limits to deduct up to $12,500 if you're single, and up to $25,000 on married filing jointly. That overtime pay will still be subject to FICA and Medicare. So the payroll taxes, it still will be subject to that, but you might get the deduction and you may not have to pay income tax. And again, this only happens from 2025 through 2028. It terminates at the end of that time. So, there are income limits on who can claim some of this overtime deduction. The deduction phases out for those earning, if you're single, $150,000 and $300,000 for married filing jointly. The $12,500 and the $25,000 are reduced by $100 for every $1,000 over that AGI limit. And so I've calculated what those limitations are. So for a single person, by the time you hit AGI of 275, you can't subtract any of your overtime. And for married filing jointly, that's up to $550,000. Now those are pretty high limits, so I'm assuming there's going to be a number of people who can take advantage of these deductions. So, who qualifies? Hourly workers, i.e., and this, when Trump put this in, he wanted it specifically to be set up for nurses, firefighters, police, first responders, those types of people. However, it does cover a lot more than just those types of people. But you have to be classified as non-exempt under the Fair Labor Standards Act, the FSLA. I brought that with me. If anybody has questions, you can come up and we can kind of go through this, but there's not a whole lot of specifics on this yet. There's some question as to how this is all going to transpire, so I may not have all the answers for you. But in order for this to qualify, you have to work more than 40 hours a week at a rate not less than 1.5 times your standard pay. So some states, like California, if you work more than 8 hours in a day, let's say you work 10 hours, you get 2 hours of overtime for that too. That will not qualify under this bill. It has to be at least 40. So if you work 10 hours and you do 3 10s and you work 30 hours, you didn't exceed the 40-hour limit. So you don't get anything. You have to exceed 40 hours. So if you work 5 10s and you get 50 hours, then we're talking about you might get a deduction. So it has to be at least 40 hours. It has to be at least time and a half, and you have to have a Social Security number. We can also qualify some salaried employees. They can be, as long as they're classified as non-exempt employees under eligible overtime. So a lot of our admins make time and a half for the time that they work over. So they're salaried, but they don't meet the definitions under that FSLA, and so they would therefore qualify. Also, there have been some questions about union people, and the answer is some union people may qualify. Again, if you've got a question on that, come see me after this. We can talk about what some of those limitations. It's not all union workers, but some will qualify. The OT must meet federal guidelines under the OT rules, and again, limitations on how much income you have to have. So let's just take a real quick look at this example. It's only the premium portion of the overtime that's going to qualify for the deduction. So what do we mean by premium portion? So here's an example. We have a nurse who makes $40 an hour. She works 50 hours in 1 week and gets time and a half for her overtime. So she worked more than 40, she got time and a half, so she meets the 2 qualifications, so that's good. But it's only the premium portion. So if you take $40 an hour times time and a half, that's $60. She normally makes 40. It's only the 20 that qualifies for this deduction. So she worked 10 hours of overtime at $20 per hour premium, that's $200. So she'd be entitled to a $200 deduction on her tax return. So just remember, it's just the premium portion, it's not all the overtime that you're working. Also, one of the things that Trump had in here was tips. And again, there's no income tax on some tip income. Beginning in 25, retroactive back to January of 25, the new law allows tip deduction of up to $25,000 from income to arrive at taxable income. There's a phase out. You can see it starts phasing out at 150 for singles, and it's gone by 400. And for married filing joint, it starts phasing out at 3, and it's gone completely by the time you get $550,000. All tip income, just like the overtime, is all subject to the payroll taxes. And again, this only runs from 2025 through 2028. The tip deduction applies to employees as well as self-employed individuals. The IRS has established a list of occupations which qualified and customarily and regularly receive tips. One of the first things Dennis and I tried to figure out was how we can pay ourselves tips in order to qualify for some deductions, but it doesn't work for us because we don't normally receive tips. But the people that you normally think about, people who work in the restaurant business or the food industry, your hairdresser or your barber, those are the kinds of people that we're talking about who normally receive tips, and they'll be able to do this. Now, you know, they always talk about, well, only the rich people benefit from this. I see a tremendous number of people benefiting from this because these income limits are so high that I think a lot of people that are in the service industry are going to be able to take these subtractions on their tax return. Okay, that's what we have for the individuals. This next part is real quick. This is just for the estate purposes. And remember, when years and years ago, you could only have $1 million in your estate, and that's what you could pass on to your heirs, and anything more than $1 million you had to pay estate tax on. Then that million went to $3 million, went to $5 million, went to $10 million. It just kept going up. Well, it's been, for 2025, it's at 13,990,000, so basically 14 million bucks. At the end of 25, this was supposed to claw back down to between $5 and $6 million. So we had a number of clients who were very concerned about what this was going to do to them. You know, we talked about gifting and trying to get stuff out and moving money out to get it out of that estate. This law permanently has moved that up to $15 million, and it will be indexed for inflation, so it will continue to go up. It will not sunset, so we know we've got 15 unless there's a new legislation that comes through and reduces it. So that's the good news, and it's still, remember, President Obama did this, he made it portable. So the husband gets 15, the wife gets 15. If the husband dies and he has an I love you will that says, honey, I love you, everything I have is yours, his 15 million, since everything went to the wife and they get a marital deduction for that, he didn't have any estate tax. But his 15 million moved over to the wife, so now she has 30 million that she could die with before they would owe any estate tax. So that's been permanently set up, 15 million, so that's the good news. I give you good news, I always have to give you bad news. State of Illinois. $15 million exemption for Fed, $4 million bucks for Illinois. And remember I said husband gets 4, wife gets 4, and then for the federal 15 and 15, and if husband died, gave it all to the wife, she's now got 30. 4 and 4, husband says, I love you, honey. Everything I have when I die is yours, it goes to wife. Does the 4 move over? No, it is not portable. Wife now only has 4 million. So how do you fix that? Well, you can kind of fix some of it with gifting. You can't gift your way out of it completely with gifting. The easiest thing is to move out of the state, but sometimes that's not feasible either. But I've had more people in the last 10 years, 15 years that have moved out of this state, become Florida residents. I mean, there are only 7 states in the country that have an estate tax. Illinois is one of them. So there's 43 other ones you could probably move to that don't have any kind of estate tax. But I did talk to Amy Ellick 2 days ago. We called her on some of these bills and the effect on Illinois that Corey's going to talk about. And I asked her about, is there any movement on this $4 million? And she says, Mike, there is absolutely no discussion at all. So not much as far as Illinois and what else the state thinks. That's all I have for individuals and estates. I will turn this over to Corey. He will do corporations, and then we have to answer any questions later. Thanks.
Okay, good morning, everybody. I am going to go over the business aspects of the new tax law. And so a lot of this really just feeds off of the 2017 tax cuts that we had. A lot of these were set to expire. So most of these provisions kind of just make some changes or tweaks to the existing law we have, in some cases making it permanent, extending. There are a few new items in here. I guess one thing to keep in mind is the effective date of some of these things. So some of these things are effective already. They started in 25. Others don't take effect until 2026. So I'll try to point those out as we go along. So the first one is the extension and enhancement of the qualified business income deduction. And so what this is a deduction equal to 20% of your business income. And qualified business income would just be basically business activity where there's continuous involvement. Most businesses qualify for this deduction. One that does not is a C corporation. So if you have a C corp, you do not get this benefit. And so under the old law, we had this 20% QBI deduction, and that was scheduled to end at 12/31/2025. So if we had $100,000 in business income, we get this $20,000 deduction just given to us. We're effectively then paying tax on $80,000 of that income. So this has the impact of really reducing our rate to 80% of what it would otherwise be. So if we had a 37% tax rate, the highest rate, 80% of that's 29.6, so that's our tax rate on that business income only. So again, that was set to expire. What the new law does is it makes that permanent. It permanently extends this QBI deduction, and it also also increases the phase out. So like a lot of these tax provisions, as your income gets higher, you start to lose the benefit. For QBI specifically, you would lose the benefit in two cases. One, if you are a service business, so we're talking about like professional services. So if you're that type of business and your income exceeds certain amounts, you're gonna lose a bit of that, potentially all if it gets too high. The other type of business that you might lose it from is a business that doesn't have enough in the way of wages or property. So if you're in one of those situations, you start to lose it based on the amount of taxable income you have. So the chart on the screen, that lists where these phase outs are and where they were. So for 2025, you can see that if you're married filing a joint return, the phase out starts at $394,000, and that goes up $100,000 up to $494,000. So what that means is if I'm married and I am below that threshold, I have no limitation, no issue. If I'm over that threshold and I'm one of those types of businesses, either a service business or businesses that does not have enough in the way of wages and property, then it all goes away. And if I'm somewhere in between there, it starts to phase out. So that range for married filing joint is $100,000, $394 to $494, and for the other statuses, the range is $50,000, $197 to $247. So what the new law did was it extended those ranges. So not only is this indexed for inflation, which is why the numbers are a bit strange, it also increased that phase out range if you're married to $150,000, and for all other statuses to $75,000. So what this does is the larger the range we have, if you're stuck in that range, you're going to get more of the deduction than you would have under previous law. So the next slide, I've got an example of how that would work. So if you have a single taxpayer who had taxable income of $225,000, which included qualified business income of $150,000 from a service business, that's the key, a service business, so we're subject to this phase out. In 2025, then in this case, since we exceeded the threshold amount, that was the 197 on the previous page, we start to lose a bit of that. So normally our deduction would be 20% of the 150, so we have a $30,000 deduction. In this case, that deduction would be reduced to $13,380. We assume these same facts, but now we're in 2026 where we have this larger phase out range. Our QBI deduction goes from $30,000 to $20,700. So just illustrating the fact that this larger range is beneficial for people that are in that range and have that larger. Another thing the new law did with QBI was it creates a minimum of a $400 deduction for taxpayers that have at least $1,000 in QBI. So even if you're in this range and you were to be phased out, or you exceeded this range and you weren't going to get anything under old law, you'll at least get $400 now. So the significance of this is, one, the obvious, the permanence of the lower tax rate. So if you've got qualified business income, you've got this lower effective rate on that income. And this QBI certainty helps with any sort of entity planning. So as a new tax law comes in, you always kind of want to think about, is the type of business I'm in and the entity that I'm being taxed as, is that the best and most beneficial way for me? And so as you're thinking about that, say between a C Corp and an S Corp, C Corp does not qualify for this, whereas the S Corp does, so this might be a reason to take that leap. Next, no change on the pass-through entity tax rules. So under old law, the IRS allowed pass-through entities to deduct state income taxes at the entity level. So why this was important is what Mike talked about, and that's that SALT limitation at the individual level. So old law, before this notice came about, if you had a pass-through business, so I'm talking about partnerships and S corporations, the state income tax related to that business was paid at the individual level. Those state taxes were taken as an itemized deduction, and as Mike talked about, that used to be $10,000, it's now increased, but there was a limit on the amount you could deduct. So what this pass-through entity rule allows is it allows the business to deduct that payment that would otherwise be a personal payment and take that as a business deduction. And so now we're taking this business deduction that effectively bypasses the SALT limit. So the reason this is important is the House version of the tax bill had this on the chopping block. The Senate version did not. And so the Senate version this. So we still have this PTE with us. And so even though the salt limit has gone from 10 to 40, we still want to use PTE when we can for several reasons. One, we've got the phase out, so once you get over that 600,000, you're going to be right back down to the 10. There still could be cases where you have more than 40,000 state income taxes that you would be limited. And the big thing is reducing AGI. So when we get an itemized deduction that's below AGI, adjusted gross income, if we're able to reduce AGI, which we can do with a pass-through entity tax, then we can help some other things on our tax return. So the amount of Social Security that is subject to tax is based on AGI. So again, if we get this business deduction, it's going to help with that. Medicare premiums, premium tax credits, medical and charitable deductions have a floor that we've got to get over. So the lower we get our AGI, the smaller that floor is. And there's all kinds of other credits and deductions in the tax code that are based on AGI. So we always want to try to push AGI down. Lower AGI is better than an itemized deduction. So if you're operating in multiple states, each state has its own version of the PTE. Not every state has it, but most do have PTE rules. So you just got to watch the state and make sure that the states don't expire, because the federal bill, was set to expire. The federal law was set to expire at the end of 25 with respect to salt. So some of the states said, well, we're going to end in 25 as well. Now that that's been extended, you just want to be sure the state does in fact extend that. Illinois over the weekend passed their law saying that they were going to extend it. So we're good in Illinois and Missouri. So the importance of this one, we just want to make sure that we're continuing to use PTE despite the fact that we've got this larger salt limit, and it also adds to the benefit of pass-through entity status. So this pass-through entity rule does not work, obviously, for C corps, because that's not a pass-through entity. It also doesn't work for sole proprietors. So if you're thinking of a Schedule C or a farmer for a Schedule F, or if you're thinking of even a rental situation, that's not going to work unless it's in a partnership or S corporation. Next, bonus depreciation. So this is the ability to write off a large portion of a fixed asset that would otherwise have to be depreciated over a period of time. So under the Trump tax cuts from 2017, we had bonus depreciation of 100% from the end of 17 through the end of 22. That slowly phased down over the years. It was set to be 40% this year, and then it was scheduled to go away completely in 2027. So what the new law does is it reinstates and makes permanent the 100% bonus depreciation. And that is for qualifying property acquired and placed in service after January 19th, 2025. So this is another one of those dates we just got to be careful on. So for the first 19 days of 2025, we are subject to 40% bonus. From January 20th, election day, through the end of the year, it is 100% bonus. And not only does it have to be placed in service, but it has to be acquired. So if you say, well, I'm not placing this in service until the end of January, I'm good with 100%, right? Well, the next question is, when did you actually acquire it? Because if you acquired it in early January, you're going to be stuck with that 40%. Taxpayers do have the ability to elect out a 40% bonus and just claim regular depreciation. In that case, you're depreciating over the useful life of the asset. And you can also elect out 100% for the period that is available. You can also elect to claim 40% for the entire year. So maybe you do that if you had planned on 40% being the amount you could depreciate this year based on the old law, so they can give you that option. So here, I guess the importance of this, just, it's always better to have quicker deductions. So the higher limit accelerates the deduction and could help create a loss. So I'll get to 179 in a few minutes, but with bonus depreciation, you can create a loss in your business. That may be important if you have multiple businesses where you need to offset loss from one business with another. You don't have that ability with 179, but with bonus depreciation, you do. So this next one is another bonus depreciation item, and this one's brand new. That's 100% bonus for qualified production property. So under existing or old law, commercial real estate generally has a 39-year depreciable life, which is not bonus eligible. To be bonus eligible, the property's life has to be 20 years or less. So commercial real estate is 39 years, so it would not be bonus eligible. However, the new law did carve out an exception for qualified production property. And so that is commercial real estate used in manufacturing or refining of a product that results in a substantial transformation. It includes agricultural and chemical production as well. They did specifically say that restaurants do not qualify, so even though that might be a transformation, restaurants do not qualify. And if you're in a rental situation, the lessee's use does not count for you. So if I own a building and you are having some manufacturing activity within that building as a tenant, I don't get to use your activity and your use of that building to get 100% bonus. So you actually have to own the building and use the building yourself to get this 100% bonus. So this one's only with us for a limited time. Construction has to begin between January 20th of 25 and 12/31 of 29, and it has to be placed in service by the end of 2030. So section 179, so this is another depreciation item. Similar to bonus, we can take all of the depreciation at once instead of doing this over time, but there are some differences. 179 under old law was limited to $1 million adjusted for inflation. That number was $1,220,000 in 2024, and that deduction started to phase out once you acquired a certain amount of property, and that was also adjusted for inflation, and that number was $3 million. So if you placed in service more than $4.22 million, you couldn't use 179. Every dollar you went over the $3 million was a dollar reduction from that $1,220,000. So the new law just increased those limits starting in 2025. So this is all the way back to 1/1 of 25. And that limit is $2.5 million, and that will be adjusted for inflation. So we've got more than double our 179 deduction now. And that phase out, which wasn't $3 million, is now $4 million. So it takes more in the way of property acquisitions to start losing the benefit. So the significance of 179, especially if we're comparing this to bonus depreciation is kind of an all or nothing. So there's different classes of assets in terms of life. So there's 5-year, 7-year, 10-year. So if I've got 5-year property and I want to bonus it, I've got to bonus all 5-year property or none of the 5-year property. I can't do some of it. It's either an all or nothing within that class. 179 differs where I can say, well, maybe I want to take 179 on some of my 5-year property, or even within a single asset, I can say, I want to take 179 on some of the bases, but not all of the bases. So because I can be more precise or exact with that depreciation, it allows me to take advantage of the tax brackets and credits. So if I want to have income of some exact amount, or if I say, hey, I've got $50,000 left in this high bracket, I want to take just $50,000 of depreciation, and I'm okay being taxed at these other rates on the rest of it. I can easily do that with 179. One thing I can't do with 179 is create a loss. So if I have multiple businesses, I'm going to be stuck. The best I can do is get to 0 on my business. So if I had business A and business B, say 2 partnerships, business A has income, and in business B, I have the ability to create a loss because I've got a lot of fixed asset acquisitions. I cannot create that loss to offset A's income with B's loss if I use 179. So that's a situation where I say, well, maybe I'll use bonus because bonus could create a loss. Then I can offset those 2 things. The other advantage for 179 is it's allowed for Illinois purposes. So when I take bonus depreciation, I get over to my Illinois return. Illinois says, no, we're not going to give that to you. So they make us go back to what the depreciation would be if I claimed regular depreciation, which means I've got to just take the amount I would get over a 5, 7, 10-year period, whatever that class life would be. Okay, deduction for domestic research and experimental expenditures. So pre-Tax Cuts and Jobs Act in 2017, taxpayers could deduct immediately domestic research, and then with the 2017 Act, there became a limitation, and that limitation started in 2022. So that limitation said, if I have domestic research expenses, I have to capitalize those and amortize those over a 60-month period. So that was the case for 22, 23, and 24. And what the new law does is it comes in and says, we're going back to the pre-2017 Act rule to allow you to immediately deduct research expenses, domestic research expenses. So they give you a couple options for this 3-year period where you can do that. So if you're a small business, you can go back and amend that 22, 23, and 24 return and claim any of those deductions that you had to capitalize that are not yet amortized. Any other taxpayer, small business or not, can deduct those unamortized expenses all in 2025. So if you had capitalized a bunch of these expenses and you had only amortized some of them, whatever's left over that you had to amortize, you can get all of that in 2025. You can also elect to take half of that amount in 25 and the other half in 26. So the significance here is just, if you're a taxpayer in that situation, you just want to understand your choices, because amending versus taking all in 1 year or over 2 years, will depend on your specific tax situation. Okay, so this one is for C corporations only. If you're an S corporation and you have a charitable contribution, that flows through the individual return, and the limitations that Mike talked about earlier will come into play. So what I'm talking about here is just for charitable contributions for C corporations. So under old law, there was no floor on these charitable contributions, but there was a 10% ceiling. So if you had contributions that exceeded 10% of your taxable income, that excess amount would carry forward and be allowed as a charitable contribution in the succeeding 5 years, also subject to that limitation. So the new law, in addition to retaining that 10% ceiling, has also now created a 1% floor. And so any deductions that you take have to exceed that 1% floor before you get the benefit. Mike talked about the individuals have this 1/2 of 1% floor, and corporations, C corporations, have a 1% floor now. Any deductions disallowed for failing to meet the floor and exceeding the ceiling will carry forward for 5 years. That doesn't start until 2026. So just like on the individual side, this charitable contribution limitation won't take place until next year. So that might be a reason in 25 to accelerate some of those charitable deductions. So an example of this, ABC, which is a C Corp, makes an $8,000 charitable contribution in 2026. The year this limitation is in effect. It has taxable income of $100,000 before considering the donations. Remember, I've got a floor and a ceiling, so my floor is 1% or $1,000. My ceiling is 10% or $10,000. So I made an $8,000 contribution. I'm going to get $7,000 in that case. So the first $1,000 I do not get because I've got to exceed the floor, and I only get it to the extent that I've exceeded the floor. Just because I exceeded the floor doesn't mean I get it all. I only get the amount over the floor. In this case, that $1,000 that I didn't get because I didn't reach the floor just goes away. I don't get that. If instead my contribution was, say, $12,000, then I've exceeded the ceiling in that case. So the $2,000 I would get to carry forward just like I got to carry forward under old law, but I would also get to carry forward that $1,000 floor that I didn't get. But I only get to do that because I exceeded the ceiling in the same year. So it may be a reason to bunch contributions if you're close to the ceiling. If you can just get over that ceiling, you're going to be able to carry forward the amounts disallowed due to the floor. So things to think about with C Corp charitable contributions, maybe you structure the payment to qualify as a business expense. So remember, a charitable contribution is something you are giving away to a charity with no expectation of return. So to the extent that you're providing a corporate benefit, whether that's an advertisement or some sort of thing where the corporation is actually getting something in exchange for that contribution, that's not really a charitable contribution. It's not a charitable contribution. We don't have to worry about these limitations. Again, also think about bunching the contributions to lose or get rid of the effect of that 1% floor. elimination of a qualified small business stock gain exclusion. So you might hear this referred to as the 1202 exclusion. So this one's been around for a while, but they've improved this exclusion quite a bit over the years. So what this says is if you have gain from the sale of qualified small business stock is C corporation stock only, not S corporations. And there's some other requirements, but if you hold that stock for more than 5 years, you qualify for exclusion of gain. Percentage of exclusion is based on when you acquire the stock, not when you sell it, but when you acquire it. So you can see if you acquire this after September 28th of 2010, you have a 100% exclusion. The exclusion is limited to the greater of $10 million or 10 times your basis. So a lot of people think of this as, maybe investments in startups where you have this large gain and they go to market, and that can be the case. This also works for other, traditional businesses that are not those types. It just has to be a C Corp. It's got to be a small business, which is now up to 75 million of assets, so small is a relative term there. There are certain exclusions on the types of businesses, but if you're considering an entity type, whether it's partnership, S Corp, C Corp, you might want to think about if your business would qualify for this exclusion, that might be a consideration in your entity choice. This is only for a stock sale. So what the new law did with this 1202 for qualified small business stock rule, it created a partial exclusion. So in the old law, you had to get 5 years to get this exclusion. So if you were 4 years and 360 days, you got 0. You had to hold it for 5 years. So what they did was, this partial exclusion says, well, if you hold it at least 3 years, we'll give you 50%, at least 4 years, we'll give you 75, and then 5 years, obviously, you're at the 100. This is only for stock acquired after July 4th and after the date. So if you acquired stock years ago, that's not going to work. It may work for the 100% exclusion, but you got to do the full 5 years in that case. You will not get the partial exclusion for anything acquired before July 4th. The exclusion was also increased to the greater of 15 million or 10 times basis. And again, if you're making any decisions, this is just one thing to think about as you're going through that. So increased threshold for information reporting. So businesses issue 1099s oftentimes in January for the previous year. Some of these 1099s, some of the more common ones, the 1099 miscellaneous and the NEC for non-employee compensation, and that's issued when the annual payments to a recipient reach $600. So that number's been around with us forever. It's a fairly low number. It causes us to have to file quite a few of these 1099s. The new law increases that threshold to $2,000, but that doesn't start until 2026, and that amount will be adjusted for inflation. So that's good news going forward. That 26 is for payments in 2026. So as you're doing your 1099s in January of 26 for 2025, we're still under the old rule at 600. It's when we get to January of 27 that we're filing them for 2026 that we have this new $2,000 rule. 1099K, so these are information reports issued by third-party payers and credit cards. So for third-party payers, which would be Cash App, Venmo, PayPal, eBay, some of the things I've listed here, they issue a 1099K when reportable payments exceed $2,500. And that was the rule that was set to be for 2025. So the new law increases this threshold to more than 20,000 and 200 transactions. So a lot of times we might have people that are, just have personal payments with Venmo and PayPal going back and forth, and if those exceeded 2,500, you would receive a 1099. Then you'd have to explain yourself on your tax return that, hey, this is just a personal situation. It's not a taxable thing. Maybe you sell something on eBay, but it's just some personal item for a loss. You still had to report it because you were getting a 1099K. Now you won't be getting those if the amount does not exceed 20,000 and 200 transactions. So both of those things have to happen. If you're a business and you're getting a 1099K because you accept credit cards, you will still get that. There is no threshold for those types of payments. It's just for those third-party payments I've got listed there. Capital gains from sale of certain farmland property. So this applies to tax years beginning after July 4th of 25. So if you're a calendar year taxpayer, we're talking about 2026 is the effective date of this one. So under old law, we didn't have any sort of income tax deferral on the sale of farmland, unless maybe you had an installment sale. Under this new law, if you're a seller of qualified farmland property, you're allowed to pay the capital gains tax related to that sale in 4 equal installments. So what that means is I figure out what's my tax if I include 100% of the sale during the year. What's my tax if I didn't include that sale in my return? Whatever that difference is the tax related to that sale. So if that tax was $100,000 related to the sale, then if it's this qualified farmland property, you have the ability to say, okay, I'm going to pay $25,000 with my first return and then $25,000 each of the next 3 years. So to be qualified farmland property, it has to be used as a farm or leased to a qualified farmer, used substantially in farming for 10 years before the sale, and there are certain restrictions on non-farm use for 10 years after the sale. So you do have to have those things in place to qualify for this deferral. Limit on excess business losses. So under the old law, disallowed business losses in excess of business income. So what this is if you have a business loss and you have non-business income, say investment income, you could always offset this business loss against investment income on your tax return. What they did was with this disallowance, they said, well, we'll let you offset business income with a business loss. But then once you have an excess business loss, then that excess, we're only going to let you deduct a certain amount. And that's based on your filing status. And for 2025, that filing status is $305,000 for single, married filing separate, head of household, and for married filing joint, it's $610,000. So that means if I had $1 million of investment income and $1 million business loss, under old law, I could just offset those, and I would have zero taxable income. Under current law, if I'm married, then I would only be able to deduct $610,000 of that $1 million loss. The other $390,000 that I didn't get gets deferred. That gets pushed over. It becomes a net operating loss to be deducted potentially in the subsequent year. So that's the provision we had. That was set to expire in 2028. The new law permanently extends this loss disallowance. The next one is the sunset of the Section 179D deduction for energy efficient commercial buildings. So we talked about earlier how 39-year property, commercial real estate is considered 39-year property, which means we've got to, if we want to depreciate that, unless it's qualified production property now, that's got to be something that's over time. So the old law said, well, if there's certain energy efficient improvements to this commercial property, then we'll actually let you take a deduction. And that deduction was based on the amount of energy efficiency, and it was a per square foot deduction. So that was kind of an immediate way to deduct what would otherwise be a 39-year write-off. Well, the new law eliminates this deduction for the cost of energy efficient commercial building property where construction begins after June of 2026. So if you're going to do any of these projects, you've got about 9 months to do that. Okay, the last one I have deals with contractors. And so this expands the long-term contract exception for any residential construction. So currently, if you are a contractor and you have long-term contracts, then in that case, you report the income related to those contracts on the percent complete method. However, there are some exceptions to that. And so a lot of times contractors are looking for exceptions to that. It allows them to defer some income. So one of the exceptions allowed contractors to be exempt from this percent complete method for a home contract. And a home contract a contract for the construction of buildings with 4 or fewer units. So if you fit into that category, that was one of the exceptions to say, well, maybe I can get out of percent completion. So what the new law does, it keeps that, the home contract rule, but it also expands it and says there's gonna be an exemption for residential contracts. So residential contracts has its own definition, and that includes construction of buildings with more than 4 units. So this applies to contracts entered into for tax years beginning after enactment date, it's July 4th. So if you have taxpayers that are building those types of properties, there's a possibility to get out of percent complete. So that's all I have.